The financial statements of a sole trader, the first statement is normally the income statement. This is the statement we previously used to call the trading profit and loss account. The trading profit and loss account. And actually, the purpose of preparing this particular statement is for us to be able to determine either the profit or the loss the business was able to generate or incur in that particular period of time. That is the main purpose. And from what we know, if we want to know the amount of profits, for example, if you want to know the figure for the profit, you take all the incomes, you deduct the expenses or the costs. All the income that you generated in that period, you minus all the expenses or the costs that you incurred, you are able to know the profit that you generated. But if it happens that the expenses or the costs are more than the income, then you are going to have a loss in that particular period. So this statement, known as the income statement, it is purely going to deal with the incomes that were generated versus the expenses or the costs that were incurred in that particular period of time. So take all the incomes, deduct all the expenses, all the costs. You will be able to determine the profit or the loss that was incurred. And the main source of income to any business organization, it is normally the sales. Any business is established to sell something. Either you are selling goods or you are selling services. But the main source of income, it is actually the sales of the goods or services the business is involved in. So that's why we normally start with it here. How much sales did we make throughout the year? When we were doing the ledger accounts, we used to say that anytime goods are sold, we credit the sales account. Anytime goods are sold, we credit the sales account. So the total amount that we have credited in the sales account for that period, that is the figure that will be captured there. The total sales for a particular period, you get it there. The only item that can affect sales, it is normally the sales returns or the return inwards. And this is the value of goods which you had initially sold, but they have been returned. So it is going to be very correct. If we have sold goods worth this much, but out of those goods that we sold, some of them were returned back. Those that were returned, they were never sold. That's why we are deducting the sales returns, because these sales returns are included in these sales, yet they were returned back. So we deduct what was returned so that we can be able to know how much was actually sold. So from sales, we will always deduct the sales.
It's not clear.
It is not clear?
Yes, kindly.
Let me check. I hope now it is going to be clear. Confirm? Are you getting me clearly now?
Yes.
Yes, actually, I was able to see that after saying something, that is when I can be able to see my reflection pronouncing the same thing. But now I think it is now clear. Thank you. So from sales, once you have captured the figure for sales, you have a responsibility of confirming whether in that question there was sales returns, because that is the only point you can be able to treat it. So if you forget to deduct the sales returns, obviously now your net sales will not be correct, and then the error will be carried forward until the end. So from sales, net sales returns, so that you can be able to get the figure for the net sales. And the net sales now, it is the actual or the correct amount that you sold, or the value of goods that were sold. Then the question is, this is what we sold, but now these goods that we sold, we acquired them at what price? What was the cost for these goods that we have sold? So we come here and we deduct the cost of sales. Cost of sales is simply the cost of the goods that we have sold. Those goods that were sold, obviously, they had initially been bought. A business normally deals with the issue of buying and selling at a profit. So we sold them at a slightly higher amount, but the question is, the goods that we sold, how much was their cost? How much did we acquire them at? That is what we call the cost of sales, the cost of the items that you have sold. So you come here, you capture the cost of the opening inventory when you are starting the year. What was the opening inventory at their buying cost? Then you add the purchases. You can be able to see here, the purchases require some adjustment. The cost of goods that you bought or the additional stock, that is the purchases. But in the process of buying those goods, you might have incurred some cost of transporting them. The cost of transporting purchases is what we call carriage inwards from the supplier to your business. So the amount that we incurred specifically for transporting the purchased goods, we call them carriage inwards, and that figure is added to the cost of purchases. That's why we are adding it here to the purchases. And then in the cost of the business operations, we might have returned some goods that we purchased. So those goods are no longer in the inventory. They are not waiting to be sold because they are already returned to the supplier. We deduct them. We deduct them, so that we can be able to know the net purchases. The net purchases, the net cost of the items we bought as additional stock. The cost, this is the amount that we paid the suppliers, that is the purchases. You then incurred the transportation cost on them. You add that. Then you less the value of goods that were returned back to the suppliers as purchases returns. Sometimes we call them return outwards. After you have done that, you get now the net figure for the items that you purchased. Opening inventory plus the net purchases gives you what we call the cost of goods available for sale. What we have available for sale in that period. And if this is what was available for sale, then we have some items that were never sold by the end of the year, which is the closing stock. If the total value of the goods that I had to sell was 1,000, that is the opening stock plus the additional stock, they have got a cost of 1,000. And then I realized that at the end of the year, there is goods worth 200 that have not been sold. Then it simply means that the goods that I sold, they had a cost of what? 800,000. I repeat, if the opening stock plus the additional purchased goods, they were having a cost of 1,000, that is the total items that we have, and we are waiting to sell them. They have a cost of 1,000. But by the end of the year, we realize that by stock taking, we still have stock of 200 that have not been sold. Then the question is, what was the cost of the items that we sold? The cost of the items that we sold will be equivalent to the cost of all the items that we had minus the cost of the items that were not sold. We get the cost of the items that were sold, and that is what we call the cost of sales. The cost of sales is simply the cost of goods available for sale. You minus the cost of closing stock. You get the cost of what was sold. Now here, after getting the cost of sales, you are going to compare. This is the cost of the sales. This is the sales. This is the amount of money that you received after selling the items. This is the cost you incurred on those goods that you sold. So if this net sales is greater than the cost of sales, you will realize the gross profit. If the cost of sales is higher than the net sales, you will realize what we call the net loss. That is how it works. So it is a matter of just organizing this work. So after getting the net sales, the question is, these goods that we sold to generate this much, how much was their cost? You compute the cost of sales. Take the opening stock, the value of the goods that we have at their buying price. You add the purchases. Purchases require some adjustments. That's why we do the adjustment in the first column. And then we get the net purchases. This is the net of the net cost of the goods that we added plus the cost of the goods that we started with. We get the total goods that are available for sale. You minus what was not sold, you get the cost of what was sold. You compare with that, you will get either gross profit or gross loss, depending on which amount is higher between these two. Once that is done, you now ask yourself, apart from the business of buying and selling stock, does the business generate other incomes? Do we have other sources of income apart from buying and selling of goods and services? Then if there is, then you are going to add them to the gross profit or loss. The other incomes can be the discount that you received from your suppliers, you treat it as an income. The commission that you received in the process of operating the business, if there is some investment that you have made and they are earning interest, the interest received and decrease in provision for doubtful debt. That one you can be able to record when you are doing the end year adjustments. When you do the end year adjustments, decrease in provision for doubtful debt, you take it as an income. So you add those incomes here to the gross profit so that you can get what we call the total income. You can get the total income here. Once you have the total income now, you will come and list all the expenses, the operating expenses now. Apart from buying goods and buying fixed assets, the business will incur other costs as expenses. The discount that you allow your customer is an expense. The depreciations that we calculate is an expense. The carriage outwards. The carriage outward is an expense. This is the cost that you incurred when you offered some transport for your customers. You offered transport for your customers. The customer buys goods, then you offer the transport for the goods sold to that customer. So that is what we call the carriage outward. This is the carriage on sales. Bad debts written off, we say, if there is any amount that you are sure that you never recover from your debtors, you write it off as a bad debt and it becomes an expense. If you have increase in provision for doubtful debt, it is an expense. Electricity, wages, insurance, rent, expense, and all that, they are considered to be expenses. Put them here, add them, transfer the total there. The total of expenses and the total of total income, if you deduct the two, they will give you either the net profit or the net loss. Once you have arrived at the net profit or net loss, that question is done. That question is completely done. The purpose of this statement is for you to arrive at this net profit or net loss when it comes to financial statements of a sole trader. How much profit did we generate or loss? That is the end of it. But now you need to be very systematic. You need to understand how this particular statement is arranged so that you don't mix some items. Let every item appear where it is supposed to appear. Sales will always start. It is the main source of income. Then you deduct the cost of sales. And I've told you the cost of sales is simply the cost of the items that you sold. Then you come here, you'll arrive at the gross profit or the gross loss. You look at the question whether there is other sources of income from the question provided. If there is, add them to the gross profit. And then you arrive at the total income. Then you deduct all the expenses. You will get what we call the net profit or net loss. And that is the end of that statement. Very important for you to note that. It deals with incomes and expenses or costs that were incurred in the process of generating the income. Just like that. Also very important to note, when you are listing your expenses here or the incomes, always look at the additional information on whether there is accruals and prepayments. If there is accruals and prepayments, they will affect these incomes and the expenses that are there. So you read the additional information carefully, find out whether there is any adjustment that you need to make on the incomes and the expenses. That is all about that statement. Any question before I take you through the other statement, and then we do 2 questions. We call it a lesson. If there is any question, you are free to ask on the income statement. So the next statement is what we call the statement of financial position. This is what we used to call the balance sheet. In this statement, we only deal with 3 items. We only deal with the items called assets, capital, and liabilities. Those are the only items that we capture here. Assets, capital, and liabilities. When it comes to assets, we know they are, those assets we call fixed assets, those that are going to be business for a long period of time. So,
maji ni moto.
Somebody to mute.
Tuchukue kikombe ile kikombe ya nini yenye iko na handle, lakini choma na hiyo. Ilikuwa sababu gani ni kwa
Elizabeth.
We understand that today is on a Sunday. We are doing the classes from our homes. So, no worries. For the assets, we know we have those assets we call fixed assets. We also have those assets we call current assets. So, in the statement of financial position, when you are capturing them, always start with these assets we call fixed assets. They are here. The fixed assets. These fixed assets, because they are assets that are going to be in the business for a long period of time, they normally undergo depreciation. They normally lose value. So that's why we have a column for capturing their cost, the price that we bought them at, what they have lost, and the remaining value, which we normally capture as the net book value or NBV. So you will come for every asset, land and the buildings. This is the cost. This is what they have lost as a depreciation. Cost minus depreciation is the net book value. For all of them, equipment, this is the cost that we incurred to buy them. This is what they have lost. Cost minus depreciation, net book value. So you do that, then your interest should be on the net book value. This is the value that we are interested in, because we are preparing this statement so that we can be able to know at the end of that financial year, we have got assets, capital, and liabilities of how much. So we are interested with the remaining value. That's why we only total the net book value. We don't total these 2. We close them with double lines like that. Those are the fixed assets that we have. Then you ask yourself, do we have current assets? These are the assets that are going to be in the business for a very short period of time, a period of time that will not exceed a financial year. They will not be in the business for more than 12 months. Inventory, and here I have highlighted, always use the closing inventory, because here in the income statement we have the opening and the closing inventory. So because we are preparing to determine the value at the end of the financial year, what is in the business at the end of the financial year is the closing inventory, not the opening. The opening, it was the inventory at the start of the year. So what is still in the business at the end of the year is the closing inventory, and that is what will be our current asset. The accounts receivables or debtors, and I have noted here, sometimes they require adjustment. So you take the debtors amount, you deduct the provision for doubtful debts, so that you can be able to know how much that you expect to receive. You minus what you might not receive, doubtful, from the debtors amount, which are actually your credit customers. If you are doubting some amount, you deduct the amount that you are doubting, so that you can record what you are sure of receiving from your credit customers. Prepaid expenses, we said these are expenses that we have paid before they are due yet, so they are as an asset to the business. Accrued income is income that we have already generated but we have not received. It is our asset. The bank balance, the cash balance. Add them, get the total here. So then, what you do, the figure for the net book value of all the fixed assets plus the total for the current assets, they will give you total assets. The total assets that we have as at that particular date when the year is ending. Then you ask yourself a very genuine question. These total assets that we have, how are they financed? How are they bought? And from the accounting equation, we know assets are either bought from capital or by acquiring liabilities. Assets are always equal to capital plus liabilities. So, in the process of acquiring these assets, we either use the capital the owner had invested to acquire them, or we borrowed them. We acquired them through borrowings, and when we borrow something, we create a liability. So they were financed by the opening capital amount. That capital amount is going to be added or to be increased by the net profit that we make, and then we deduct the drawings. From what we know, drawings are the resources withdrawn from the business for the owner's personal use. Resources taken from the business for the owner's personal use. They decrease the capital. That's why we deduct the drawings, we get the closing capital amount. If the business had long-term liability, for the sole trader, the long-term liability is normally the bank loan. Capture it there. And then you finish by capturing the current liabilities. What we owe the suppliers or the creditors, also known as the accounts payable, the bank overdraft, accrued expenses, prepaid incomes, you add all of them, the total current assets. Then closing capital, long-term liability, total of current liabilities, they give you the figure here, total capital and liabilities. Total capital and liabilities. And then that is the end of it. This figure should be the same as this, because the accounting equation dictates that assets must always be equal to capital plus what? Liabilities. This and this should be the same. Having said that, I want us to spend a maximum of 40 minutes or 45 minutes. We do 2 questions only. And those 2 questions, we shall prepare the income statement and the statement of financial position from each of them. Anybody with a question?
Mwalimu, you're going a little bit too fast for some of us.
Sorry?
I'm saying you're going a little bit too fast for some of us. Before we write anything, you're already to the next point. I don't know whether we can be able to cope.
I was just reading the format. We are now going to do the question. We are not going to rush now.
Hello, mwalimu. Bwana
Yes.
Makoli.
Salama sana.
Is it Bwana Makoli, nisikuite jina yenye si yako?
Ni yeye.
Oh, these notes are in the whatever, the what, like a flow, the flow of processes.
Yes.
They are in our notes, eh?
They are on the LMS.
Okay.
Don't worry. Don't even bother writing a lot. Huh? The formats are and all that. Huh?
Okay.
Yes. But for the others who are not on the LMS, I will share a PDF for the same.
Mr. Makore, I have a question.
Yes, yes.
Is it possible you can take us through 30 enterprises?
That was the. Am I the one who shared?
30. No.
Who shared
We were
that?
given as an assignment,
Yes.
but I'm getting a different answer. I'm getting less by 40,000.
You are getting a different answer.
We were given the net loss, but I'm getting a different answer.
Huh?
We were given that question as an assignment last Sunday,
Yes.
but I've tried it myself and I am not getting the right answer. I don't know if it's possible you can go through it very fast.
Do you have the answer?
Yes. we were given the answer.
Oh, you are given the answer.
Okay, Mwalimu, quick one.
Yes.
Mwalimu,
Yes.
quick one.
Go ahead.
There is, I think, same question that he has asked.
Yes.
I think we were not told how to treat carriage. Was it car returns outwards? That 40,000 she's talking about. If you add the 40,000, you won't get the answer that you were given. But if you don't put that 40,000 for, I think, for returns outward, you get the 859 that you were given as the answer.
Let me look for that question. You have said it is known, the business is known as
30 enterprises. 30.
Hadi. Can you send it to me?
I've already shared on your WhatsApp.
Hadi Enterprises. Okay. We can go through it. Let me share with the others who are not in this group. You are in which class? Tuesday, Thursday, or Saturday?
Tuesday. No, Thursday. Sorry, Thursday.
For Saturday, it has been shared. For Tuesday, shared again. For the others, diploma, also shared. So I think everybody can be able to access that question. Then that question, we need to use this flow. We are told we prepare the income statement for the year ended 31st of December 2019. I will just edit what we have here and remove what is not provided in the question. So the business name, we are told it is known as Badi Enterprises. So I'm going to replace this. The business name is Badi Enterprises. It is the income statement that is prepared for the year ended. Put the figure there, that 1st of December 2019. Then we go now to the figures. How much were the sales? We are told it's 1059,000. Then ask yourself, do we have sales returns or return inwards? Yes, we have. Return inward is the same as sales returns. And the return inwards is worth 9,000. So if you deduct 9,000 from this, you will get 1050,000, and that will be your net sales. That will be your net sales. Then we now determine the cost of sales by first of all capturing the opening inventory. The inventory that is dated 1st January, it is the opening. The year started 1st January, 100,000. We add purchases. The purchases from the question is 745,000. Then carriage inwards, it is given there as 10,000. Then purchases returns or return outwards. If you look at it, it is somewhere there at the mid row, 3,000. So we'll do this computation, 745 plus 10,000 minus 3,000.
752,000.
That is your net purchases, 752,000. If you add to 100,000, what will be the cost of the goods available? This is the cost that we have bought this year, plus the cost of the goods that we started with opening inventory, will give us the total cost of goods that are available for sale, 852,000. Then from that, you minus the closing inventory, and it is written there as inventory into bracket that 1st December. That 1st December, it is this date when the year is ending. So this is the closing inventory. We put there 85,000. That will give us the cost of goods or the cost of sales. How much is that?
767,000.
767. You need to deduct. This is the cost compared to the sales. In simple terms, the sales, the amount that we received from sale of these goods is 1050,000, and those goods had costed 767,000. So if you deduct the sales revenue minus the costs we incurred, what is the gross profit?
283,000.
283,000. And in this case, it is a gross profit. So we edit that. We remain with the gross profit. Then do we have other incomes?
Yes.
Other incomes, we have...
Discount received.
Yes, it is there. How much is it?
72,000.
72,000. What else do we have? It is the only one.
No other income.
No other income. So we remove the others. They are not provided. This was just a format. They are provided how we treat them. So the only other income you have is that. So if you take gross profit from plus this, what do you get as the total income? This is the gross profit plus discount received.
355,000. 55,000.
Correct. Then now you go to the expenses and list them as provided. So the expenses are just, let me list them. We have commission paid. If it was commission received, it could have appeared under the income, but because it is paid, it is an expense. Sorry, put the figure. Commission paid is 28,000. General expenses. $128,000. Electricity. For 4,000. Carriage outwards.
It's 40,000.
40,000. Discount allowed.
96,000.
Rent expense.
64,000.
4,000. Licenses.
24,000.
4,000. Wages.
730.
730. Repair and maintenance.
52,000.
52,000. Stationery.
8,000.
6,000. So if you add those, how much will be the total for all the expenses?
Twelve, 14,
Sorry?
1,000, 214,000.
14,000.
Mm.
So if this income is less than the expenses, then the business will realize what we call the net loss
Margin.
of how much? The total income minus the total expenses.
859. Negative 859,000.
859,000. And that is the answer. That is the answer for that.
Mm. Mwalim, I have a question. What if there was a prepaid, there was, there was prepaid insurance?
If there was
An
prepaid
example.
insurance is not
An-
there. Maybe
An example.
it was prepaid general expenses.
Mm.
Maybe it was 2,000. We could have just adjusted this figure. If there was a prepayment of, we said all the prepayments we needed to deduct. We deduct the prepaid amount for the accruals we add. So we could have come here, the figure was 44,000. This one, we minus maybe the prepayment was 2,000. We could have captured here was 2,000. Together. Prepayment we deduct. If it was accrual, we could have added. So that is how we treat it.
Excuse. Hello. Hello, Mwalimu.
Yes.
Carriage inwards.
Yes.
Have you recorded it? Or
Yes,
what is it?
there.
Oh,
It is here. We added to purchases. That is a cost that is incurred on the purchases. We add it direct to purchases. If purchases were not made, carriage inwards could not have been incurred.
and carriage outward.
Carriage outward becomes an expense.
Oh. Okay.
Mwalimu, I still have a question about prepaid.
Yes.
Does it mean that, so if I paid before 31st of, was it before 31st of 29 of December, an
Yes.
expense, I had 2,000, and now there's another another expense. So you add.
Come again.
if before the year ended, I had 2,000 prepaid expense for 2,000. So I add.
I know.
Deduct.
You do that.
Prepayment,
Oh.
that means
No, I did that. Okay.
a prepaid amount is an amount that you have paid, but you paid in excess. So by the time this year is ending, that amount you have already paid, but you have not utilized because you paid excess. The excess will be utilized in the next financial year. So we deduct from this financial year because we are supposed to capture only the expenses and the incomes up to the end of that year. If there is anything excess we received, we minus. If there is anything that we have not received or paid, we add. Are we together?
Yes.
Yes. A prepayment is an amount that you have paid but in excess. Meaning that if it was a prepayment of general expenses by 2,000, it means that yes, we paid 44,000 for general expenses, but 2,000 is in excess will be utilized the next year. So we minus from this financial year, then we shall be able to account for it in the next financial year where it is going to be utilized. Now, prepayment, don't think about it. Any prepaid or amount paid in advance, deduct here. Deduct here. Whether it is income, we deduct here. Whether it is expense, we deduct under the expense. And then we know how we are going to treat it in the statement of financial position. But if it is an accrued, outstanding amounts due, those are figures that we have not paid by the end of that year, we add them. Accruals we add, prepayments we deduct. Okay, that was, by the way, on that question. So we go to the document that I sent you this afternoon. There's a document I shared. On income statement and statement of financial position questions. I want us to deal with those questions, two of them now, and then I will give you an assignment with one of them. So question one says that the following balances were extracted from the books of experts as at that 1st December 2011. So we are given the sales, premises, purchases, drawings, carriage outwards, capital, debtors, creditors, bank, salaries and wages and rent. And there is some additional information here. And we said the additional information in most cases we apply it when we are doing the end year adjustment. There is an outstanding wages. This is an accrual of this, while there is a prepayment of rent of 15,000. And you are told to do an income statement and a statement of financial position for that period. This one is very summarized, but what I want to emphasize, when it comes to this statement, just understand what goes where. Anything that is an asset will never appear in the income statement. Something like premises. Premises, I told you, this is land and buildings. This is a fixed asset. It will never appear in the income statement. The only thing that can appear there, maybe it is the depreciation if you are told that all those premises are depreciating. The purchases will go to the income statement. Drawings we normally deduct from capital, and the capital is captured in the statement of financial position. So it will never appear in the income statement. Carried outwards, it will appear in the income statement. Capital will appear in the statement of financial position. The same with the debtors, statement of financial position. The same with the creditors, statement of financial position. The same with the bank, statement of financial position. Salaries and wages that are expenses, they will appear in the income statement. Rent is an expense, will appear in the income statement. You need to know the items and where they belong. In the statement of financial position, we have said assets, capital, and liabilities only. In the other one, it deals with incomes and expenses, all that. So let us prepare. Let us prepare. I start with the income statement, and that should always be the statement to start with. This is expert. That's the name of the business. Then we have the income statement for the year, and remember the income statement is always dated for the year ended. Then you capture the date when the year ended, that 1st of December 2011. Once that is done, underline that heading. Then we shall have our columns. And here, two are enough. 4 columns are enough. That means, or I can put the 3 of them, but this one we shall not use it. The 3 columns for the income statement. The first column, actually we need 3. We need 3 because of carriage outwards. The first one is normally to adjust the purchases. Purchases add carriage inwards less purchases returns. We normally do that computation here. And then the others two, they are used to accumulate the figures, then we transfer the total to the last one. So sales is 439,800. We said the only thing that can affect sales is sales returns or return inwards. So you run through the question, find whether it is there, and actually it is not there. We don't have sales returns, so that is like our net sales. We come here, then you say less cost of sales. Those goods that we sold and generated 439,800, how much did they cost us? Opening inventory cost. The opening inventory, which we did not have. It is not anywhere to be seen. Look at the
Mwalimu,
yes.
I need to get something right. You have said when you're doing the income statement, you're supposed to have sales, income, and expense. That is what goes there.
Yes. This
And
is
then
incomes and expenses. How much did you generate? How much did you incur?
okay.
Yes. The other
And
one,
then the one for
assets.
financial position is assets, capital, and liability.
Only. Yes.
Okay, okay.
So if you look at this question, they did not provide the opening inventory. If you look at those balances given there, there is no opening inventory. The inventory that is provided under the additional information, it is the closing because it's the inventory at the end. So this one is not given, put a dash there. Then you add purchases. Purchases, 292,800. We have carried inwards. We don't have, we only have outward, but we have, actually we don't have even purchases returns. So actually we don't, this figure, because it does not have any figure to be added to, it is better we put it here. Because we don't have carried inwards, we don't have purchases returns. So this figure is not going to be adjusted. It is like our net purchases. We take it there direct. We only put here when there is a carried inwards or purchases returns or both of them. So this and this one not given. Opening plus purchases gives us that. That is the cost of goods. available for sale. Then from what is available for sale, we normally left closing inventory. Closing inventory is the additional information 171,400. So that we can get cost of sales. You get 221,400. Take it to the last column, 221,400. Sales minus cost of sales. In this case, we are going to realize gross profit because sales is more than the cost. To 18,400. The gross profit. We have incomes. We have other incomes, discount received, commission received, interest received, rent income. We don't have the rent that is there is an expense. So we shall come here and say less expenses. Let us start with those that are captured under the additional information. Bullet 2. On that 1st of December 2011, outstanding wages. So we need to do an adjustment on salaries and wages. The figure that is given for the salaries and wages, 61,100. We said when it is an accrual, and this one is actually an accrual because it is an outstanding money that we have not paid. It is 4,200. So 61,100 plus that will be 65,300. That is what we were supposed to pay. Then also says that while prepaid rent, so we also need to do an adjustment on rent. How much was paid? 87,000. You minus, we said when it is a prepayment, you minus because we paid excess by 15,000. So for rent, we were supposed to pay how much? 87 minus 15. You are to pay 72,000. Those are the only ones that require adjustments. If now we have others, we capture them direct here. Carriage outward is an expense. You take the way it is, 17,500. There is nothing else. Capital, debtors, creditors, bank. Those ones belong to the statement of financial position. Here, this is all. So the total expenses for that period. $154,800. This and this will give you now the net profit for that year. $53,600. That statement is done. You just work with what provided. If it is not given, leave it. That is the income statement. We are supposed to draw the statement of financial position for expert traders again. That is Roman 2. The good thing is this question is very simplified. We don't have depreciation. So we can do it very fast. So remember the difference on debt in this. For the statement of financial position, we normally say as at. But for the income statement, we normally say for the year ended. This one we normally write for the year ended. This one we say statement of financial position as at that date. So we start with the fixed assets. And because we are not given depreciation, 2 columns will be enough. We don't need to do cost, depreciation, and then net book value, because they have not provided depreciation for the fixed assets. So here, the only fixed asset that is here is the premises. And I told you that is land and buildings combined, 580,000. That is like the net book value. No other fixed assets. Come here and then capture current assets. Start with the closing inventory. It was given as the additional information bullet 1, 71,400. Do the cumulative total there. We have the debtors. $1,7,800. We have cash at the bank. 37,600. 37,600. And then we said if there is any prepaid expense, that amount of money that we have not utilized, that prepaid rent of 15,000, it is our money still. We have not utilized that. Any prepaid expense, in this case, it was a prepaid rent of 15,000. It is a current asset. It is our money that we have paid, but we have not received the services. That will give you the total for the current. I'm getting 294,800. So fixed assets plus the current assets will give you total assets. Page 74. 800. Close with the double lines. Then you come here and you say those assets they were financed by capital, and the figure for capital is 620,000. To that capital you will add the net profit. The net profit figure is what we got here, 63,600. Then you deduct if there is drawings. Yes, there is. Of 8,500, if I'm not wrong. Yes, 8,500. It's 20,000 plus 63,600 plus 8,500 minus, sorry. You get 603,100. Do we have a bank loan? We don't have, so we don't have long-term liability. Then you have the year, the current. Creditors, what we owe the suppliers, 267,500. Then we are told outstanding wages. That is an accrued. Anything that we have not paid. Accrued expenses, they are liabilities. Let me adjust my camera. Good wages for 200. You have not paid, so you add that. $267,500 plus 200. You get 271,700. So you have the capital and liabilities. You add them. 874,800. Total capital and liabilities. Total capital and liabilities, like that. So, and we have actually come to find that the total assets, total capital and liabilities, they are the same. Therefore, assets is equal to capital plus what? Liabilities. We have satisfied that equation. We have satisfied that equation. So that is how expert trader statements were supposed to be done. Any question? So the profit that you get there is the one that you come and add it to the capital. So instead of the examiner providing the net profit, they will tell you to prepare the income statement so that you can be able to arrive at the net profit which you bring here. Add it to capital. If there is any drawings that were made, you deduct, you get the closing capital. If there is bank loan, we could have captured the long-term liabilities here. But because there is no bank loan, there is no long-term liability. So we skipped the long-term liabilities and we went to the current liabilities. There are creditors, outstanding wages, accrued expenses, and liabilities. Then that one is it. I want to do question 3. Then I leave you with question 2 to try. Question 3. So that is the question. The following is the balance of Tayari wholesalers as at 31st December 2014. So you are given the balances, you are given the additional information, you are told to prepare the two financial statements. The income statement for the year ended 31st December 2014, statement of financial position as at 1st December 2014. The same procedure, nothing changes. So we have the sales. Sales is here. We don't have sales returns. We have the purchases here, the opening inventory, the closing inventory is here under the additional information. It's a very good question. Let us do it. Tayari wholesalers is the business name.
Do sales. Sales. Sales is 1.5. Just working out, okay? This is for animation. 1.5.
For the year ended at 1st December 2014. So the sales amount 1,500,000. I told you the moment you have captured sales, the next thing you need to confirm from the question is whether we have got sales returns or return inwards so that you can deduct from that amount. So you just go through the question, find out, do we have sales returns? We don't have. So that is the final sales. Then come here and we say from that sales, we need to less the cost of those sales. This one you underline because you need to compute or to derive it. Start with the opening inventory. Inventory 1st January, 122,500. And purchases. Purchases figure, it is 350,000. So I want to know, should I capture it here or I take it here direct? What dictates is whether we have got carriage inwards or return outwards or purchases returns or both. Do we have any of those? If we have them, then we need to adjust purchases here first before we transfer the net purchases here. But if there is no carriage inwards, there is no purchases returns, then we just write it here direct because no adjustment is required to be made on it. And actually, I don't see carriage inwards. I can't see purchases returns or return outwards. So that 350,000, just take it here. Then you do this and this to get what is available. Cost of goods available for sale. This one will be 472,500. From the cost of goods available for sale, we normally deduct the closing inventory, which is normally the additional information in most cases, 60,000. That will give us, this one we are asking, put it into brackets. That one will give us the cost of sales, which we shall take to the last column where we have got the sales. This one will be what? That is 500. This one will be 21. This one we are asking also put it into brackets. Sales is higher than the cost, so we are going to get the gross profit. $1,087,500. That is the gross profit. We agreed that gross profit, it is normally going to be affected by other incomes. It is going to be increased when we have the other incomes. So we confirmed we have discount received, in rent received, commission receivable, and all that. If you look at the last figure on those balances, there is rent receivable. That is an income. You add there. Rent receivable, 60,000. That is another way of generating the income. We don't have discount received, commission received, interest received. So that is the only one. So we add it so that we can be able to determine total income. Which is coming to 1147,500. Then from there, less expenses. Let us list them. What are the expenses that we incurred in generating this income? I would like going to the additional information so that I can adjust what is meant to be adjusted. Bullet 2, motor vehicles are depreciated at the rate of 20% per annum. So depreciation is an expense, right here, depreciation on motor vehicle, 20% times the value of the motor vehicle. The motor vehicle is 1 million. So what is the 20% of 1 million? $200,000. That is an expense. Roman 3 or bullet 3, on that 1st December 2014, that is when the year is ending, accrued office expenses amounted to 12,500. So we need to do some adjustment on office expenses. We said when it is accrued, we add. That amount of money has not been paid. We paid 77,500. There is a balance of 12,500. $90,000 is what we are supposed to pay. 90,000 is what was supposed to be paid. We have done the adjustments and we are through. Let us pick the other expenses now direct. Capital is not an expense, land and buildings is not an expense. We have salaries. We don't require any adjustment, 960,000. Purchases is not an expense, motor vehicle no, office expenses we have adjusted. Sales not an expense, drawings is not an expense, accounts receivable no, accounts payable no, bank no, inventory no. So those are the only expenses. $1,250,000. In this business, the expenses are more than the income. So the business will get or will realize a net loss. Net loss. Net loss of 1 or 3,000. Is 102,500. 102. That is all. Once you have arrived at the net loss or net profit, that is the end of the income statement for the sole trader. The net loss, that.
Excuse me, Mwalimu.
Yes.
When you use the word net loss, then you don't put in brackets, or you still put in brackets to show that it's negative.
It's good, yeah. Net loss.
Thank you.
Thank you. It's a negative. It's a minus. Once you have done that, we need to come and now do tayari all sales. Statement of financial position. Remember, this one is as at. The statement of financial position as at that date. The other one is for the year ended. So we need to do fixed assets, after the year cost, after the year accumulated depreciation, and then determine the remaining value or the net book value. In Tayari Wholesalers, we had land and buildings, with a cost of 2,662,000. From the additional information, no depreciation is provided on land and buildings, so they are not missing value. So the net book value remains 2,662,000. No depreciation on land and buildings is provided. Then we have motor vehicle. Their cost is 1 million. The depreciation that we calculated there, 20% of 1 million, it is 200,000. So the remaining value is 800,000 less cost minus depreciation is that. No other fixed asset is provided. You don't need the cost, you don't need the total depreciation. We are only interested with the total of the net book value. That is what we are. 2,662, 800,000. It is 34,62,000. Then you capture the current assets. Don't forget the closing inventory. The closing inventory, it is under the additional information bullet 1, 60,000. Accounts receivable. These are simply the debtors. 90,000. We also have the bank. 4,000. Nothing else. If you do that total, for 14,000. That's the net book value. Gives us a total assets of that 876. Total assets. Add the fixed asset value plus the current asset value, the total assets in that business by the end of the financial year, they are worth 3,876,000. How are they financed? Financed by capital. How much is the capital at the start? 3,638,000. 3,638,000. We said when the business has realized a loss, it reduces capital less the net loss, 102,500. Put it in brackets. We have drawings so that we can also less. Yes, we also less the drawings amount. The drawings amount is at 4,000. So that we can get the remaining capital after paying the loss and deducting the drawings. 102,500. You get 3,501,000. 3,501,500. That is the capital at the end of the year. We have a bank loan, that is a long-term liability. This question, no loan, so no long-term liability. We then finish by capturing the current liability. Current liabilities. Accounts payable. And I insist this is the other name for creditors. What we have not paid our suppliers is 362,000. Then there is amount that we have not accrued expense. There is an amount that we have not paid for office expenses. Accrued office expenses amount that is yet to be paid, 12,500. So that one gives us what? 362 plus the 12,500, 374,500. This is the closing capital, this is the current liabilities. That one will give us the total capital and liabilities. We get to the 876,000, which is this one. Assets must be equal to capital plus liabilities. So capital and liabilities, this is the figure. Total assets, that is the figure. They are equal. They are equal. Assets must always be equal to capital plus liabilities. A should be equal to C plus R. So C plus R, the figure is here. And then A, the figure is here. So they are equal. Huh? That is how we do it. It is very simple. Understand what is an expense, what is an asset. If it is an asset, is it current or fixed? If it is a liability, is it long-term or current liability? And then you arrange them in that manner without mixing them. Without mixing them. Where we are capturing assets, let us not find the current assets there. Let us not find the current assets in the middle of the fixed assets. Let us not find the fixed assets in the current assets. Let us not find the assets captured as expenses. Categorize them the way they are supposed to be categorized, and then put them where they belong.
Hello. A little clarification. Up there, you had three columns on cost, Kenya shillings, accumulated depreciation, Kenya shillings, and net book value, Kenya shillings. Now going down, you have listed the current assets along that column, or that's not a column of accumulated depreciation. Or
Remember, I
what is
closed here. The purpose
or
of
you closed? Oh,
I have closed this.
okay, okay.
And any figure that I'm now capturing below the double lines, I'm not going to add it to the figures above the double lines.
All right, all right, all right. Noted. I thought we needed to list them at the cost. Kenya shilling. It's okay, me.
Then you accumulated them in the second column, you transfer the total here. You accumulated them in the second column, you transfer the total.
Okay, okay, noted.
Excuse me, Mwalimu.
Yes.
On the treatment of rent receivable, maybe you can explain why it wasn't treated as an asset, as a current asset.
That is an income. You know, an asset is it is something that is there. It is something that is existing. But now this is money that is coming in. Rent receivable, it is money coming in, so it is an income. It is under the other incomes. It is not something that we can go and find it in the business. It is not there. It is money generated. Money generated or money coming in is the income generated from rent, income generated from interest. This is not an asset. Both actually the assets, they have physical presence. You can be able to find it apart from the debtors. The others, it is something.
Okay.
Good. Any other question? Well, if there is no any other question now, as usual, we end
Mwalimu, how did you say we should treat a long-term liability?
if there was there, we could have captured there. Remember how we did the format? In the format that I gave you, after capturing the capital, the second item should be long-term liability. And there we could have written long-term liability, we underline, and then we capture the bank loan, put the figure there. But in this case, there was no loan, there was no bank loan. So that's why I omitted. It is supposed to fall in between here. Before you capture the current liabilities, long-term liabilities should appear first. Put together. Long-term liability should appear. So we could have captured long-term liability. We capture what is it. Then we go below that. We capture now current liabilities. But the figures should always come to this end. Have you understood?
Yes, thanks.
So practice the other question. The other question that I'm going to leave with you, if you look at it, it does not have the sales and the purchases. Question 2. They have provided the gross profit, which is a very common case. So they did not give you sales, purchases, and the inventories and all that. They have only provided you with the gross profit. So it is like they have done part of the question for you. They have done part of the question for you. So when you do that question, you are going to start, you are working from here. The heading should be the same. You write the name of the business, the income statement for the year ended, capture the date. But now you are working, so you start from here. You are starting from the gross profit. So instead of starting with sales here, you will just capture gross profit, put the figure of the gross profit that is in the question. If there is other income you add, then you less expenses, you just get the net profit or loss. So you are not going to do this part. This part we normally call it the trading. This part where now we deal with gross profit and the expenses, this one we call it profit and loss. The P&L. So you are only doing this part, gross profit, but we capture it from the top. Gross profit and incomes less expenses. So that is what you do. So don't be so much surprised. Where is the sales and the purchases? Start from there, finish that question on the income statement. And then once you have the net profit now, you will take it to the statement of financial position. I intend to stop there. Anybody with a question? If there is no question, we will stop there.